Next, we have Brian Coffey, portfolio manager and a veteran of NS Partners. They manage the Nedgroup Investments Global Emerging Markets Equity Fund. In addition to bottom-up stock picking focused on quality growth companies, NS conduct extensive research into macro, country, and liquidity conditions in order to inform portfolio construction as an additional source of alpha generation. Good morning, Brian, and thanks so much for joining us. How are you today?
Good, thank you, Anil. Thank you very much for the invite. Very happy to run through what we've been up to on the fund and what's happened over the past year.
Yeah, brilliant. Thanks so much. I do have just a few questions for you, which I think clients will get a lot more insight into what happened with the fund over the past year. Shall we get started?
Yes, please.
Okay, great. So, Brian, the first one is just from a performance perspective. The fund went through a little bit of a difficult time in the past year relative to the index. Can you please talk us through some of the numbers as well as some of the contributors and detractors? And I know that you and the team place quite a lot of emphasis on the country and liquidity analysis, as well as if you can just please touch on kind of the stock selection and sector allocation as well, please.
Sure. Yes, and 24 was another difficult year for relative performance. EM as an asset class lagged developed markets, and in particular, everything lagged the US, as we all know. Emerging markets were up about 7.5%, and the fund delivered a disappointing 5.3%. If we look at what didn't work on the fund, really, it was mainly Chinese security selection and exposure in China, but also the overweight in some of the ASEAN markets didn't work during 2025, particularly post the Trump election victory. So that meant that our overweight in Indonesia and Thailand were difficult for fund performance. Stocks and financials in those markets struggled, and in IT, particularly in Korea, we had a difficult time. We had a small overweight in utilities in China. That was a headwind for relative performance. That reflected a cautious stance on China until we got some clearer signs that Xi Jinping may be about to initiate some support for the economy. It wasn't all negative. So what did work for us during the quarter, we had some exposure to energy in the Argentine economy via Vista. That worked very well for the portfolio. We were underweight Brazil for the year, and we've ended up slightly underweight Brazil, although we added and took away stocks as they delivered relative performance. Our stock selection in Brazil was very strong last year. In particular, Petrobras in the first half of the year was very strong, and some of the utilities in Brazil worked well for the portfolio. The underweight in Mexico and the underweight in the Gulf region was also a positive contributor. And in Taiwan, we had a small overweight on average for the year, but that did move around during the year. We actually ended up with a slight underweight in Taiwan, but our security selection in Taiwan worked very well for the fund. Similarly, in India, stock selection was positive. And if you looked at it at a sector level, the underweight in energy and materials were positive. Stocks that we held in industrials worked quite well. Similarly, in consumer staples, healthcare and communications. And our overweight in consumer discretionary was a slight offset in security selection in that. Also, the overweight in IT worked well for the quarter. At an individual stock level, as I mentioned, in Korea, we struggled because Samsung Electronics lagged. And the reason for that was its failure to gain confirmation from NVIDIA that it would be a high bandwidth memory supplier. So that really disappointed. However, we've held on to the stock and we're seeing some signs of recovery in it, and we're ever hopeful that they will get that NVIDIA certification. We also had in China, we had a a software service company, Shanghai Baosite, which underperformed. So it's in the IT sector quite naturally, being in software, but it really underperformed, particularly the AI-linked hardware names in the IT sector. So that was a negative contributor. And then, as I mentioned, in the ASEAN region, as interest rates have not come down as quickly as investors had been hoping post the Trump election in particular, our Indonesian financials hurt performance. So Bank Rakyat Indonesia, it was an outperformer in Q3, but it pulled back in Q4 as the Trump trade boosted the US dollar and sort of put a question mark over yields. It wasn't all negative. So again, we've got two big winners in 2024 in India. Max Healthcare Institute, a private hospital provider, had been concentrated in the New Delhi area, starting to open up in other territories within India, but that's been a fantastic performer, very good capital discipline in the company, mainly greenfield expansion, but improving margins and good top line growth. Varun Beverages is a name we've mentioned many times in our earlier reviews. Pepsi Cola bottler across the Indian South subcontinent, and again that had a very strong 2024. We still like the company, but just to put it in context, we started the year with about 3.5% in Varun, and we've taken profits consistently, and that's why it's been such a strong contributor. And we now have about 1.5% in Varun. So those were the offsetting good factors. In terms of changes over the period, well, we added to China, and there was some revision of our holdings within China in response to, as I said, the signs of support from Xi Jinping for the economy, although we've yet to see the details on that. We also added in UAE, and I mentioned that we had some two-way trade in Brazil. So we added some names in Brazil and then trimmed those. We have been taking profits in India. So Varun was an example of that, but we reduced the overall weighting there. We also reduced Indonesia, Philippines, and Poland, and our exposure in Poland. And at a sector level, we added to industrials, consumer discretionary and staples, while reducing utilities, energy and financials over that period.
Thanks, Brian, for all the detail. I mean, I guess now, what about Trump? It seems like many people have extremely good things to say. Some people have extremely bad things to say. There's a lot of comments in between as well. So from a fund management perspective, you and your team have definitely been trying to kind of preemptively assess the impact on the portfolios and his policies. How have markets reacted thus far, please?
Yeah, so from our perspective, we think that markets are responding fairly similar to what happened in the prior election and later inauguration of Trump. And this time there seems to be expectation that it's going to be terrible for global trade with tariff regimes causing inflation, giving us difficulties in lowering interest rates, or the authorities' difficulty in lowering interest rates, that it's going to be inflationary. We think that's possible, but it's not our expectation. So our monetary analysis for the global economy suggests that we're looking at a weak first half of the year, and that inflation pressures are likely to continue to recede and to move within or even below most most central bank targets for inflation. So we think that interest rates are likely to fall in 2025. We don't think that the impact of trade is going to be as detrimental to EM as people suggest. It was the same story at the last time, if you recall. And in the end, if you look at what happened post the election, China outperformed EM, and EM started to recover after the inauguration, when we actually saw the policies being implemented are not as severe as people had anticipated, EM started to recover. And the US dollar itself in Trump's first year, post his inauguration, actually was slightly weaker over that following year. So, he's always a very important influence on global trade and expectations. But from where we are now, it's not so different than what we saw in Trump 1.0. So for us, from here on, we see lots of room for EM to outperform. We think China can do better. We don't think that the dollar is going to continue to appreciate, and we think that interest rates are going to come down. But that's in response to weaker inflation than the markets are currently anticipating.
And Brian, just related to that as well, just specifically on China and Mexico, which really seem to be in Trump's targets, what's the exposure to US exports at the moment, and how much can it really hurt if he wants to get quite nasty about this thing?
So, there's a couple of viewpoints on tariffs and the impact of Trump on trade. If you look at China in particular, Trump was hostile to China in his last term in office, and Biden was also pretty tough on China. And if you look at China's dependence on the US as an export market, it's really not that significant. So it's actually been coming down as China has exported around Asia and the southern southern EM markets in particular. So I don't think it's such a big problem for China, although the mood music is certainly not going to be positive. China's got a very competitive currency, which will allow it to continue to be an export country. Mexico, exports as a percentage of GDP in Mexico are a completely different story than the case in China. So whereas in China we're looking at sub 3% of GDP exported to the US, in the case of Mexico, that's closer to 25%. It has been falling recently, but it's closer to 25%. That's not net exports. So China takes a lot of intermediate goods from the US and then re-exports them back to the US. However, Mexico, that was. So Mexico is in a more difficult position, it would seem. The thing is that one of the issues for Trump seems to be the potential for Mexico as a backdoor export venue to the US by China. That hasn't been the case so far. So most of the exports from Mexico to the US are mainly American companies doing some production in Mexico and then re-importing those goods into. So we don't see much a threat to that. However, it's definitely going to be part of his negotiating tactics. In terms of Chinese investment for their, if you like, Trojan horse entry into the US economy, they really are a small part and have been a relatively small part, but not zero. So we're not dismissing it. They've been a small part of FDI into Mexico. It has increased in recent years, but it still remains much smaller than US or European or Korean or Taiwanese investment in Mexico. So we don't really see that as a huge issue. Further, if you look at what happened in terms of tariffs during Trump's and Biden's tenures, it's just that the pattern of exports to the US changes. So now we see exports coming from, again, it's grown in Mexico, but we also see Vietnam being added, and the rest of Asia, other Asia, has increased significantly. There is some, if you like, offshore Chinese production that would be directed towards the US from those regions, but those are really if you like, Asian export stories. So those are Chinese companies that have invested in production in Asia. It's not manufacturing in China. It's not re-export of Chinese goods to the US. It's actual Asian manufacturing exporting to China. Exporting to the US because they have a competitive advantage on a wage basis. If you look at China, that will continue to happen. It will continue to be an export market to the rest of the world. Its penetration in the US will continue to climb, is our expectation. But its share of exports to the rest of the world will probably rise. So they'll export their excess capacity. Tariffs themselves, are those inflationary? They can cause some inflation aspects in the US, but that needs to be accommodated by central banks. And if it's not, then they won't be inflationary. So you'll see some price increases. You'll see some people won't buy goods that they used to from China, but they'll buy those goods from other markets like Southeast Asia. You're not going to see low cost or low margin manufacturing shifting back to the US. That's really not what happened, not our experience.
So Brian, thanks very much for that. And as I alluded to earlier, you and your team do quite a lot of work on the liquidity analysis and flows across the different emerging markets. So can you please give us an update and overview on what you're seeing at the moment, please?
Sure. So, monetary data analysis is kind of core to our process, and it's very important in selecting our relative weightings in different countries. So, if we look at the E7, so the largest economies in emerging markets, which continue to include Russia, you see that they're very weak. You've got weak momentum in China, India, and Brazil. And Russia is now at crisis levels. So the Russian number drags down E7. But we can strip that out and replace it with Indonesia, which we'll show you that in a later slide. If you look at the rest of EM, the numbers are improving and getting better. So you'll see that Mexico has picked up, Taiwan has picked up, and most of those markets, while not having particularly strong monetary growth, they have improved and they are better than China, India, or Brazil. If you look at the E7 number relative to developed markets and you replace Russia with Indonesia, so redefined E7, that gets back up to the G7 level. So it's as good as the US plus all the other developed economies. So that for us is quite positive for the emerging market outlook in particular. And then if you look at exchange rates, we've seen significant response to Trump and his election in Q4 in particular. And we've seen a significant correction in the exchange rates, which were overvalued, in our opinion, for both Mexico and Brazil. But they still remain relatively elevated. So a lot of the froth has gone out of both those currencies. Last year, Mexico in particular was a huge beneficiary of nearshoring flows. So people were keen on that economy and that market based on the nearshoring opportunity, anything but China. That has dissipated. In Brazil, the politics has been messy and the currency has taken a correction as a result of that. However, if you look at our final chart, you can see that China remains very competitive in terms of currency, but Korea is also looking competitive. So, non-China Asia, we think, is still a good story in terms of looking beyond the first half of 2025 and a recovery in global economy.
Thanks, Brian. And if you just had to, let's say, tie all of that together, what's your strategy for the fund at this point looking forward, please?
Sure. So, we remain cautious on global growth the first half of 2025. We think that labour and inflation news are going to soften during that period, and probably cause further declines in interest rate easing by central banks. In terms of the global stock building cycle, we've seen a bit of a recovery in that, and we're moving towards a less favorable phase. But we don't think that's an issue for emerging market economies where cyclical sectors have underperformed developed market cyclical sectors. So we think we've got good catch-up potential for EM into that environment. Chinese money growth has been recovering, but it's not particularly impressive, and we need to see a further increase in that to warrant optimism. Now, obviously, the authorities in China are holding back on all of their policy options while they wait to see exactly what comes from the Trump administration. But we would expect to see further support from the Chinese authorities for their domestic economy. Chinese dependence, certainly from a GDP level on the US as an export market, really is, I think, overemphasized by markets. So we don't see that as exceptional. We think that China is going to continue to be an export-driven economy, but they'll have to refocus on domestic consumption. And we're hoping to see that start in 2025. Money growth is soft in India, and that's been the reason why we've reduced our weightings there. But again, we think that the Indian economy is one of the better economies as we move forward 25 and 26. So we would expect to be increasing exposures to that market when we see a recovery in those monetary aggregates. However, we're not seeing that at the moment. The rest of Asia, again, we would expect to see improving monetary aggregates as those interest rate declines come through globally. We think that the rest of Asia is well positioned for that. And so our overweights in countries like Indonesia, Philippines, and Thailand will benefit from that. Brazil and Mexican exchange rates have had a big correction. We still think they're slightly overvalued, less than they were. But when you compare them to China and Korea, which are undervalued, we think we prefer the Asian exposure. Politics has the potential to change swiftly. Money numbers have improved in Mexico, and we may move back to that market when US policy towards it becomes a little clearer. But for the time being, we're zero weighted in Mexico and we're underweight Brazil.
Brian, thanks very much. Maybe just to end off, any final words on kind of over and underweights to countries and sectors? You've spoken quite a bit already. Is there anything else you just wanted to add before we close off?
Yeah. Naturally, our kind of cautious outlook for the first half of 25 has led us to be underweight energy and materials, and that's worked reasonably well for us. We continue to hold that cautious outlook, but again, we think that cyclical sectors in EM have reflected that weaker outlook, and therefore are more likely to be an add to us. So not necessarily an overweight, but we might reduce the underweights in those sectors as 25 progresses. In terms of regional exposure, India is our favoured market, but at the moment we're at neutral, and that reflects really the monetary aggregates. The Taiwanese and Korean markets and the IT sectors for those, we think those will continue to benefit from AI investment and from declining interest rates as we move forward. So really, it's a cautious first half view, but optimism on relative performance for the asset class and for Southeast Asia in particular for 2025.
Brian, that was brilliant. Thanks so much. We appreciate your time, and we look forward to chatting to you again soon.
Okay, look forward to that indeed, and hopefully we'll have better numbers for 2025 than the disappointment we've seen in 24.
I'm sure it will be. Thank you.